So every person who invests in the stock market usually worries about two things. The first is the fear that the market is too expensive and it will crash right after the investment. The second fear is the fear of missing out. The fear of missing out on even more gains if one does not invest right now. These fears are totally normal and can make you feel stuck, not knowing what to do. So in this video, we are going to look at historical data on how much money you could have made if you were the worst timer in the market, which means you invested right before the market crash in the last 100 years, from 1929 to 2020. Plus, we'll discuss ways to invest that will lower your risk and what to do if you find yourself investing at the market peak. My name is Kanak and welcome back to my channel. Your support is what keeps this channel running, and if you find this video helpful, then show your support by liking and subscribing to the channel. Let us take a look at how investments performed if you invest your money just before the market crashes over the last 100 years. On your screen, you will see 8 major stock market crashes, from the Great Depression in 1929 to the global financial crisis in 2007. After these market peaks, the stock market dropped by anywhere from 90% to 35%. The returns you are seeing are the average annual returns over 10, 20 or 30 years from these market peaks. So as you can see, over a 10-year period, except for the Great Depression in 1929 and the dot-com bubble in 2000, the annual returns turned out to be positive in almost all cases. However, if you had held on to your investment for 20 years or more, your returns would have generally ended up being in double digit. Again, with the exceptions for the 1929 Great Depression and the 2000 dot-com bubble. What this data tells us is that if you stay invested for a very long time, like 2 or 3 decades, there is a good chance of getting decent returns on your investment. And remember, these returns are the worst case scenario. Over the long haul, the worst case scenario doesn't seem too bad. Of course, if someone can cleverly predict the market peak and avoid investing just before a crash, they might end up with much higher returns. However, predicting the market peak is extremely challenging, even for the most sophisticated market experts. As the famous saying goes, time in the market is more important than timing the market. Now let's get to the main question. Should you put your money in the stock market if you think it is at its highest point? Well, when you look at the numbers, studies actually show that investing when the market is hitting new highs usually leads to better returns in the following period than waiting for a market dip. The main problem with waiting for a dip is that it is super hard to predict when the market has reached its peak. Trying to time it perfectly is pretty much impossible. And if you try to do it, there is a very high likelihood on missing out on investing opportunities. Secondly, markets are discounting machines. They factor in the future outlook of businesses in the stock prices. So, if the market is going up, it does not necessarily mean it is about to crash. In fact, more than often, it means there are positive signs for businesses in the near future. Even though the numbers tells us investing when the market is high can be a good move, our emotions like fear and greed often mess with our rational thinking. So as an investor, here are some ways to keep emotions in check while still avoiding the risk of buying at the peak. Firstly, there is a thing called dollar cost averaging. It is like spreading out your investments into equal parts and investing money at regular intervals, like every week or month. This strategy helps average out the price you pay for your investments and helps you take advantage if the market crashes. But the drawback is that you might miss out on some gains if the market is on the rise. But still, it takes the emotion out of your investing decision and helps you stick to your investment plan. The second important strategy to reduce your risk is to invest for a very long term. It can be tough to stay invested when your portfolio has crashed, but if you stick with it for 10, 20 or 30 years, there is a good chance your investment will bring in returns you need to reach your financial goals. So let us summarize the key points. Firstly, just because you think the market might be at its peak does not mean you should hit the brakes and stop investing. Trying to predict the peak is like finding a needle in a haystack, almost impossible. Secondly, to lower the risk of buying when the market is high, try dollar cost averaging your investment. This means spreading out your investments equally over time, helping you to stay on track and keeping emotions out of your decision. The third is think long term, that is 10, 20 or 30 years. Even if you start at market's peak, history shows there is a good chance you'll end up with positive returns over the long haul. And again, here are the most important words. Time in the market is more important than timing the market.